One of the greatest myths of the stock market is that you need large sums of money to invest. In fact, when you have little money to invest, you literally have not only one, but several advantages that big investors don't. Welcome to 5-Star Finance. If you have small sums of money to invest, we're going to show you how to beat the market and achieve higher returns than the institutional investors. What is considered a small sum? Before we dive deeper into the video, let's get on the same page when referring to small sums. It's not about how much you consider a large sum to be, but how the secrets we are sharing with you today will work with a range of dollars invested. A small sum is any amount less than $1 million. Investing in small business. Patience and persistence are handy in every aspect of life. Smaller progress can bring big results if we mix it with persistence. As Warren Buffett puts it, it is better to wait for the perfect pitch to swing your bat instead of swinging at every pitcher. So, how can small business lead to big results? Let's assume you're trying to win a giveaway organized by an online agency. But the problem is that more than 100,000 people have registered for it. But what if, on the other hand, there is a giveaway being organized with less than 1,000 people participating in it? It's simple. Your chances to hit the jackpot are on the brighter side. Small businesses stay away from the radars of most of the analysts. Investors tend to seek the recommendations of analysts for better targets, and because of that, these stocks can have higher chances to be undervalued and proportionate big returns on the invested capital. Are you aware of the high rate of return that only small sums can make? Small investments can lead to a high rate of return, and that's how the compounding effect works. Your profits can stack up gradually, and by the time you're maturing in the industry, your dividends are already hitting the $1,000 mark. This is the reason Warren Buffett and other successful investors had skyrocketing return rates back when they started investing. Small sums in their area of competence and expertise is what worked for them. To put it simply, there are half a dozen people who would compound $1 million at a 50% rate, and interestingly, the same people could not compound $100 million or $1 billion at nearly that rate. This emphasizes the importance that only small sums can make. This also means that when you will get up to that $10 or $100 million mark, you are less likely to get that return rate going for yourself. You have to take the volume of the stock into consideration, and that means the amount of shares any single security trades off in a day. For example, if there's a stock that's worth $2 a share, and it only trades at about 100,000 shares a day, it means that there is a total of only $200,000 trading hands in that one trading security. This means that if you're going to invest $10 million into that stock, it's going to take months and months for you to build up that position, which is why larger sums are less likely to help you execute those big thresholds of return than small sums. They do not trade in bigger volumes, and there is not that much money changing hands in that one company. According to Warren Buffett, if you start small, you must find your circle of competence and be ready to invest when you occasionally find the wrinkles in the market. When working with a small sum, there is an opportunity for a high rate of return, but this advantage can disappear rapidly as the money compounds. As a matter of fact, Warren Buffett won't be looking for those small sums anymore, but for people just starting off and trying to score big, this strategy can pull off wonders. Finding these opportunities was easier 40 years ago, but today, these opportunities are rarer, which just emphasizes how the industry has grown and the stock market has revolutionized itself. Less competition. Some of you are new to the game of investing, and truth be told, not every investment is going to bring skyrocketing dividends for you. Or is it? Finding these stocks that are easier to acquire at good rates might be complex, but once thoroughly understood, they can make things work for you. As we said, when working with a small sum, there is an opportunity for a high rate of return. But why does this happen? There are three main reasons. The first is that hedge funds and analysts do not pay attention to smaller securities because they can't invest their large sums of money, and this might leave the door open for young investors. The second reason is due to the lack of coverage. Less people are aware and ultimately leads to less competition. The third and last reason is that due to the lesser media coverage, many people take these sums as speculative investments and decide to invest in stocks that are being talked about constantly. You need to find small securities in your own area of competence, which Warren Buffett also likes to refer to as your own circle of competence. What that means is that you need to question yourself about which areas in the market you are comfortable with and what areas in the market you are the most knowledgeable about. The circle could be the area you're most familiar with, or one you're personally acquainted with because you work in that particular industry. This might give an advantage over other investors in the same market, as your familiarity and your knowledge are likely to provide you with a firm grip. Warren Buffett prefers to remain within his circle of competence, which is why we see him consistently invest into companies with very similar characteristics. Also advises to invest within your own area of expertise and your own circle of competence, whether you're investing in a small company or a large one. This really applies to all investing, no matter what you're looking at. Another helpful advice for investors just starting off is to occasionally find wrinkles in the market. This might be a difficult concept to grasp at first, but simply means to find a stock the market is mispricing and create a little wrinkle we can take advantage of. It might happen from time to time, and we can find it a lot in smaller companies after they experience sell-offs. These sell-offs cause these smaller companies to sell way below their normal values, and it gives them an extremely low financial ratio and more certainty to invest in. Sometimes there are these wrinkles in the market, and if you can identify them, you will be able to buy stocks at very cheap rates. Finding these little wrinkles takes time, but as Warren Buffett says, if you can find them, your return can be skyrocketing and can really provide you with a boost that will help you in your career. Once you succeed in finding that mispriced stock in the market, the sell-offs are already doing their job. This can help you in buying cheaper stocks. Reinvesting your money in certain companies, though, might not be a good idea, as you're likely to fall off into a dividend trap. Companies might distract you with big dividends, but in the long run, the value of your shares is likely to drop, which will be a big blow to your progress. So keep your head up, your shoulders back, and wait patiently for the appropriate moment to hit the perfect pitch to score big. Warren Buffett and other of the greatest investors of all time had their best years with outstanding performance in the early days. Wonder why? Now you know. But before you dive into these opportunities, you must know that there are a total of 6 stock categories, and the approach to analyze each one of them is different. Check out our free ebook in the description below if you want to learn more about it and increase your chances to hit the perfect pitch. Now that you understand the dynamics of investing small sums and how these investments can lead to higher return rates, you might still be thinking, don't I need money to start investing? Well, yes and no. You don't need money up front because monthly contributions are more important than the initial investment sum in the long term. But that's a topic for another video. If you have small sums of money, you have an advantage. What actions are you going to take now that you know about small sums and their impact on return rates? Let us know in the comment section below. Check out this video we handpicked for you, and we'll see you in the next one.